Let me take you by the hand and walk you into the psychology of the market, the collective mind reflected through price. We're going to explore how to interpret the market's intent, not through prediction, but through awareness. Before we dive in, recall the previous lesson on spotting big opportunities. That's where we built the foundation. Today, we step into a deeper layer, understanding how your own perceptions interact with what the market shows you. You and I both know the market doesn't speak in words. It doesn't announce, "I'm going higher now." It communicates in probabilities, through subtle shifts, pauses, reactions. That's price behavior. And when you learn to observe without bias, to recognize those subtle messages without projecting expectation, you begin to flow with the market instead of fighting it. Picture it. The early morning screen glows before you, charts alive with movement, coffee in hand. The market is silent, yet expressive. Every tick, every candle is a reflection of collective belief. What does that moment of hesitation tell you? What does that sharp rejection mean about how traders are thinking? This is what we're here to uncover: how to recognize the psychological energy embedded in price. You must become a student of market psychology, not to predict outcomes, but to understand behavior. As you study that behavior, something in you changes. Your mindset matures. You no longer chase certainty. You develop trust in the process. You learn when to act and when to stay still. Growth comes not from control, but from alignment with what the market is expressing. So let's move step by step into how to read the market's intent through price, and how that connects directly to your beliefs about risk and money. We start with a principle. Price reflects all available beliefs. Every piece of information, every fear, every hope already expressed. The chart you see is not just data. It's a mirror of collective perception. That's why you don't need to predict news. You need only interpret the flow of confidence and fear revealed by price. Suppose you see a sharp decline, long red candles, heavy volume. What's being revealed isn't just selling pressure. It's emotion, fear, capitulation, the release of trapped energy. The question isn't, should I short? But what story are traders telling themselves right now? Are they acting out of panic, or are professionals exploiting that panic? You don't assume, you observe. You let the market confirm through follow-through, not through your anticipation. Now imagine strong green candles bursting upward. Excitement, conviction, greed, perhaps even euphoria. But again, what matters isn't the move. It's whether conviction is sustainable. Are participants confident, or are they exhausting themselves? You look for hesitation, for contradiction, because your edge lies in awareness, not reaction. You let the market reveal itself. You listen more than you speak. Every swing, every hesitation, every failure is the market saying, "This is what we believe right now." Misread that belief, and you'll fight the crowd. Respect it, and you'll move with flow. Let's bring in structure, support and resistance, supply and demand. These are not magical lines. They represent collective memory, zones where beliefs have previously clashed. When price revisits a prior level, it's the market asking, do we still believe what we believed before? Watch closely. Those reactions expose the mindset of participants. If price approaches resistance and stalls, long upper wicks form, sellers appear, belief in lower prices persists. But if candles compress and then burst through with volume, it's not just momentum. It's a psychological shift. The crowd's belief is transforming from doubt to conviction. At support, when you see rejection wicks or hammer bars, that's confidence emerging. A group of traders unwilling to let price fall further. If the level breaks decisively, it tells you conviction has flipped. The story changed. Your job is not to predict it, but to recognize when the narrative shifts. Now, pay attention to tempo. A swift move through a zone tells you there's emotional urgency, conviction. But beware, conviction can disguise manipulation. False breakouts exist because traders are attached to being right, not to reading the message objectively. A quick spike beyond a barrier and a reversal? That's the market saying, can you stay neutral, or will your bias control you? The disciplined trader doesn't defend a belief, they question it. Zoom out. Context. Higher time frames hold the broader narrative. If the daily chart shows an uptrend, higher highs, higher lows, then a pullback on the 1-hour chart is simply a test of belief. Do traders still trust the trend? If weakness emerges, lower highs, strong selling pressure, the collective confidence is fading. But if price stabilizes near support and strength returns, the belief remains intact. Intent is never isolated. It's relative to the broader story. Do you see how this connects back to big move formation? There we identified where energy builds. Here we read how that energy releases. The question isn't whether the breakout happens, but whether belief sustains after it. Let's explore specific signals, not as certainties, but as expressions of emotion and probability. First, the inside bar, contraction, indecision. Traders are waiting, uncertain. When price breaks, it reveals which side has more conviction. But you don't assume follow-through. You wait for confirmation. Second, pin bars or rejection wicks, an attempt rejected. The market tested a belief and found resistance. That long wick is doubt made visible. Third, engulfing bars, aggression, dominance, a stronger belief overriding a weaker one. But again, the true measure is conviction, shown by volume and continuation, not size alone. Fourth, the wick sweep, deception. The market tempts, then reverses, exposing emotional traps. Only awareness protects you from reacting impulsively. Fifth, break and retest, the belief test. A breakout followed by a return to the level asks, do we still accept this new reality? If buyers defend it, confidence is real. If not, belief collapses. Sixth, trend continuation versus reversal, the eternal psychological tension between those who trust the current narrative and those who doubt it. Your job is not to choose sides, but to observe where conviction actually lies. Every candle is a contest of beliefs, buyers and sellers expressing emotion. Volume amplifies that message. Without it, you're reading whispers. With it, you're hearing the crowd. Big candles on big volume show commitment. Big candles on small volume show illusion. And then there's time, the silent variable. Time in consolidation reflects indecision. Time in movement reflects belief strength. The longer the compression, the more explosive the release once belief aligns. Now, momentum. A fast move reflects confidence. A sluggish one reflects hesitation. Combine speed, volume, and context, and you can feel the conviction behind price. Picture this. An uptrend on the daily, a pullback on the 1-hour to a key support. You notice inside bars, consolidation, then a sudden bullish, engulfing candle on volume. That's confidence returning. The crowd's belief shifts upward again. You wait for confirmation, a retest, a hold, and then align your position with the prevailing conviction. Or consider the opposite, a downtrend on higher time frames. On a lower time frame, price rallies into resistance, forms upper wicks, then reverses sharply. That's disbelief reasserting itself. Sellers reclaim control. You lean with the flow, not against it. This is where mindset meets method. You don't act because you need to trade. You act because the probabilities align. You let the market define strength. You detach from needing to be right. The best trades often come from patience, not activity. Sometimes the greatest expression of confidence is waiting. And always, manage your perception of risk. No pattern is perfect. You will misread. You will lose. But if your belief in probabilities is stronger than your fear of being wrong, those losses won't threaten you. What destroys traders isn't losing money. It's the emotional attachment to outcomes. You grow when you stop fighting what the market shows and start aligning with it. Every price move confirms the collective state of mind. Price action confirms belief. You don't take guesses without confirmation. You wait for evidence. When the market moves, you let it show you intent through consistency, not through hope. A breakout is not an invitation to jump. It's a signal to observe. If you act before the market confirms its story, you're no longer trading probabilities. You're trading your own need for certainty. Let the market reveal its energy, its conviction, its follow-through. That is confirmation. Understand this deeply. False moves and traps are not failures. They are psychological tests. The market probes belief. It tempts, deceives, exposes attachment. Every failed breakout is information, not betrayal. Often those failures create the fuel for the real move. Your task is not to avoid traps, it's to interpret them. Watch what happens after the break. If price fails quickly, if rejection bars form and momentum collapses, that's the crowd caught leaning the wrong way. Awareness lets you step aside, or even trade the reversal, without emotion. If the break holds, volume supports it, and the retest confirms, that's conviction. That's where you align. Context is everything. Watch for extremes: parabolic emotion, overextension, exhaustion. When price is stretched far beyond perceived value, it reflects belief pushed to its limits. Euphoria feels powerful, but is inherently unstable. When you see candles losing range, bodies shrinking, wicks overlapping, the message shifts from aggression to fatigue. The market is preparing to rest, retrace, or reverse. Another subtle teacher: rhythm and order flow, how price behaves across sessions. Opening bars, late session reactions, mid-session pauses, all reveal behavioral patterns. Every market has a psychological heartbeat. Notice how participants behave at recurring times, how fear or confidence enters cyclically. Those patterns are micro-expressions of collective mindset. Combine them with structure to see the full emotional landscape. Divergences between momentum and price also reflect changing belief. When price makes new highs but momentum lags, the enthusiasm behind those highs weakens. It doesn't guarantee reversal. It signals that conviction is thinning. The wise trader listens to that fading energy rather than forcing continuation. Ask yourself, how many times have you forced an entry because you thought price should move your way, only to be stopped out just before the actual move? That's not bad luck. It's resistance to reality. You weren't listening to price, you were imposing belief. Let go of the need to be right. Replace it with the desire to see what's true. In trading, alignment is worth infinitely more than accuracy. You trade best when your perception matches the market's current truth. Every trade you take should come from clarity. The market must be speaking clearly. Here, I intend to break. Here, I intend to test. Here, I intend to reverse. If you can't hear that message, you wait. Patience is not inaction. It's confidence. Sometimes the market goes silent. That's fine. Study. Wait. The opportunity will reappear. And when it does, you'll recognize it without doubt. Let's study a scenario: range expansion. After a tight consolidation, Price drifts sideways, emotion contained. Then, suddenly, conviction erupts. One side surges with volume. That's decision. But even then, don't leap at the first candle. You wait for continuity, candle 2, candle 3, to prove the belief is real. Then, if a retest validates the breakout, that's your cue. Consolidation was uncertainty, breakout was conviction, retest was confirmation. The three-step psychological dance. Don't confuse randomness with intent. Markets breathe, flicker, mislead. Whipsaws are simply noise within uncertainty. Let the sequence of behaviors separate truth from randomness. One candle doesn't define a shift, follow-through does. Risk management is your emotional anchor. Stops are not punishment, they're structure. They protect your mental clarity. Place them where the market's message invalidates your thesis, not where your fear begins. Too tight, and you'll interpret noise as failure. Too wide, and you'll drain conviction. Keep risk small. Tiny losses preserve your emotional capital. Then reward multiples. 3, 4 times risk. Become meaningful, not desperate. Never fall in love with direction. The market is fluid. Your thinking must be too. If price starts contradicting your expectation, don't defend your bias. Re-listen. Adapt. This flexibility is not weakness, it's mastery. Ego resists change. Awareness embraces it. Humility is the ultimate trading edge. Every trade is a lesson in perception. You don't command the market, you learn from it. Each mistake sharpens awareness. Over time, repetition molds intuition, an instinct born from structure and confirmation, not emotion. You'll begin to feel when belief shifts, but that feeling must rest on evidence, not impulse. Here's a framework to internalize. Identify structure, trend, range, or consolidation. Mark key levels, zones where emotion previously turned. Wait for price to approach. Observe behavior, candles, wicks, volume, speed. Wait for confirmation, break, retest, or consistent follow-through. Enter with defined risk, logical, not emotional. Manage the trade. Watch for signs of failure or belief shift. Exit when structure invalidates your premise or exhaustion appears. Repeat this with discipline. Each repetition rewires your brain from guessing to perceiving. Over time, you feel the market's intent because you've trained your mind to listen, not react. This principle, reading market intent, is the natural evolution of identifying big moves. Back then, you learned to spot buildup. Now you learn to discern truth from illusion. Both together sharpen your edge. So when the market coils, when tension builds, what do you expect? Don't think in outcomes. Think in probabilities. Ask, what is price showing me right now? That single shift from opinion to observation changes everything. It frees your perception. You stop forcing trades and start flowing with clarity. Your success won't come from loud opinions, but from quiet recognition. EBU moves never appear from nowhere. They evolve from subtle cues. Tight ranges, failed probes, hesitant wicks, all foretell the emotional shift before eruption. When the market finally commits, you'll already be in sync. Sometimes you'll miss the first move. That's fine. You wait for confirmation, for the second opportunity. Patience multiplies edge, chasing destroys it. When you act decisively, with risk controlled and mind calm. And remember, you're not trading for random profits. You're trading for asymmetry. You engage only when the odds tilt in your favor. Price reveals those tilts. Discipline allows you to exploit them. Patience and humility keep you alive long enough to benefit. So tonight, as you study charts, listen for whispers. Failed breaks, retests, fading momentum, exhaustion wicks. Ask, what truth is price revealing here? Don't impose your expectations. Let the market speak. Move only when clarity arises. If you can recognize intention before the crowd does, if you can feel when collective belief shifts, you gain an edge that's not mechanical, but psychological. You're no longer predicting, you're perceiving. And perception, aligned with probability, is where true mastery begins. We'll continue this conversation and dive deeper into the inner architecture of trading, how patterns form, how to manage trades once you're in them, the psychology of holding positions, and how to strengthen the muscle that reads intent. Reading intent isn't about predicting direction. It's about observing response. That single distinction can redefine everything about how you approach markets. The biggest misconception most traders bring into the game is this. They think their job is to predict. They stare at charts, searching for certainty, convinced that if they can just forecast what comes next, they'll win. But prediction is not trading. It's ego. Observation, on the other hand, is discipline. The market doesn't reward profits. It rewards those who can interpret behavior and align with it. When you focus on reaction instead of prediction, you stop demanding that the market obey your expectations. You stop arguing with price. Instead, you begin to listen. Ask yourself, when price moves sharply against you, what's the market really saying? It's communicating rejection of your idea. The faster you listen to that message, the faster you protect capital. Reaction is listening. Prediction is speaking. The consistently profitable trader listens more than they speak. The chart is not data, it's dialogue. Each candle is an answer to a previous question. You can't know the exact words that come next, but you can recognize the tone, confidence, hesitation, aggression, or caution. That tone, visible in momentum, volume, and structure, tells you far more about what's probable than any forecast you could invent. Trading by reaction means interpreting tone, not writing the script. Picture this. Price tests a resistance zone. The predictor says it must break higher. The fundamentals support it. The observer says, let's see how price behaves here. The predictor buys on belief. The observer waits for evidence. Does price hesitate? Does volume confirm? Do candles close with strength or rejection? If price bursts through cleanly, the observer joins. If it stalls, they stand aside. The predictor risks ego and capital. The observer risks only patience. You cannot control what the market does, but you can control how you respond. That's the essence of reading intent. You watch behavior around key zones, support, resistance, prior highs and lows, and interpret how the crowd reacts. If buyers defend support repeatedly, intent is bullish. If sellers fail to drive lower even with high volume, sentiment is shifting. None of this requires forecasting. It requires awareness. Think about how often you've been right about direction, but wrong about timing. You called the move correctly, but entered too soon and got stopped out before it began. That's what happens when prediction overrides observation. You can't dictate timing. You can only recognize when timing reveals itself. The market might intend to go up eventually, but if you act before confirmation, you're often buying the exhaustion of a pullback. By the time the true move starts, you're out or underwater. That's why reacting beats predicting, because reaction aligns you with reality. The best traders are not those who guess the future most accurately. They're the ones who respond most effectively. They let price show its hand. They wait for the footprints. Volume expansion, directional closes, alignment with the broader context. Each clue pieces together the market's intention. Price intent reveals itself in reaction to new information, not in what you think should happen. Suppose a central bank shocks the market. One trader instantly buys or sells based on their opinion. Another simply watches. The first spike, the retrace, the stabilization. They're not passive, they're reading. If the spike fades, it means the crowd overreacted. If it stabilizes and holds support, conviction is real. The observer trades response, not narrative. That's the difference between emotional and disciplined traders. Predictors are emotionally attached to their ideas. Observers are emotionally neutral. They interpret. Observation detaches identity from outcome. You're not trying to prove you're right. You're trying to see what's true. And when you focus on truth instead of ego, your entire relationship to risk, entries, and exits changes. Observation demands patience. You must let the market show its intent before you act. Impatience is the death of discipline. Most traders lose because they can't tolerate uncertainty. They need action. But true observation requires comfort in not knowing. When price breaks a level, you wait to see if it holds. When volume spikes, you wait to see if momentum continues. You trade confirmation, not assumption. Understand that the market often disguises its real motive behind noise. False breakouts, stop runs, and deceptive wicks exist to expose those who act without confirmation. These are tests, not punishments. The market probes conviction. The impatient gets shaken out. The patient get rewarded. A fake breakout reverses quickly. A true one holds. Observation helps you tell the difference. Visualize a chart locked between two levels. The predictor says it's due to break soon. The observer replies, let's see how it behaves at resistance. Price surges, forms a long wick, then closes weak. That's rejection. The predictor is trapped. The observer is safe or even positioned on the other side. The reaction told the truth. Observation also governs trade management. Suppose you're long in a trend. Price stalls. A predictor holds, insisting the pullback is temporary, because they need to be right. An observer studies, are dips being bought? Is selling pressure increasing? If yes, the story shifts. They adjust, protect profit, or exit. This responsiveness is how you stay in sync with the market's reality, instead of trapped in yesterday's opinion. Observation brings emotional neutrality. Predicting fuels attachment. Observing fuels curiosity. You become the detective, not the preacher. The detective doesn't accuse before evidence, he follows the clues. That's your role. Even your entries change. Instead of calling tops and bottoms, you wait for price to prove rejection. For longs, you watch sellers fail. Wicks rejecting lows, follow-through buying. For shorts, you watch buyers fail. Upper wicks, loss of momentum. You don't guess, you confirm. Ask yourself what's more reliable, your opinion or the evidence of what's actually happening. Every trader who endures long enough will tell you the same truth. Trade what you see, not what you think. What you see is objective. What you think is ego. Observation isn't passive. It's active awareness. You're constantly tuned into speed, volatility, and micro-behaviors in candles and volume. This deep attention trains your intuition. You begin to feel shifts before they're obvious, not from guessing, but from recognition of repeated behavior. Even your money management improves when you think in reactions. Your stops rest below areas where evidence fails, not arbitrary numbers. Your targets align with zones where reactions historically change again. Everything becomes structured, logical, and detached from emotion. The market rewards humility. Predictors shout, I know. Observers whisper, let's see. One burns out, the other evolves. Every great trading system, no matter how complex, rests on this simple foundation. Wait for the market to reveal intent through reaction. Trend continuations, retests, reversals, all of them are just reactions read accurately. When price reaches a level, ask, how does it respond? Is it absorbed or rejected? Does volume support or dry out? Does momentum align or fade? Each question removes prediction and replaces it with evidence. Mindset is the final layer. When you trade by observation, you think in probabilities, not certainties. You stop saying, it will go up, and start saying, if price reacts this way, I'll respond that way. That language shift rewires your brain for flexibility. You no longer need to be right, you only need to be aligned. You enter when evidence appears, you exit when evidence changes. This ties directly back to our earlier principle, spotting where tension builds before expansion. Now you're learning to see when that tension releases. You don't predict it, you witness it. The build-up is preparation, the reaction is proof. Together they form your edge. Traders who master this seem intuitive, but it's not mysticism. It's trained perception. They recognize familiar reactions repeating over time. They've internalized the rhythm of belief and behavior. So when you face your charts, resist the urge to play prophet. You're not here to forecast. You're here to witness, to read behavior, to interpret reaction. The chart always reveals its truth to those patient enough to listen. Price is pure psychology made visible. Fear, greed, hope, and regret woven into every tick. That's why fundamentals often lag behind price. Price moves first because emotion always leads information. The market is a living reflection of human belief. Every candle is a psychological footprint. Have you ever seen headlines like, stock crashes after strong earnings? Of course you have. Why? Because emotion moved before logic. The crowd already expressed its belief through price. By the time the story arrived, the truth had already been told. Price is the story told in real time. Fundamentals are the story told after the fact.